Hello and welcome to our final preview video for the IMF annual meetings. To discuss the outlook for Nigeria's economy, I'm joined today by Jean-Francois Tremblay, the Associate Managing Director of Financial Institutions for Moody's. Jean-Francois, thank you for your time.
Thank you, James.
Now, we saw some very disappointing GDP growth numbers from the second quarter of this year for Nigeria. Just how tough are things right now for the Nigerian economy?
Yeah, the Nigerian economy is in a tough spot right now. The low oil price environment is obviously hitting the oil exporters themselves, but also the government quite heavily, given its high dependence on oil revenue for its fiscal expenditures. And in addition to having this primary level sort of impact, there's another channel that affects the economy and the banks, and it arises from the very policies that the government is putting in place in order to deal with this situation. And more particularly here, I have in mind the depreciation or devaluation of the naira. And thirdly, in that context, the investors have lower confidence. They're probably delaying investments. Consumption is lower. The banks are lending less. And all of this is contributing to a sort of mutually reinforcing dynamic. So for the time being, we think that low economic growth, low loan growth at the banks is here to stay for a little while. The banks will still go through a rough patch. But in the longer term, towards the end of 2016, further out, we think that the situation will stabilize as a low naira would typically help exports in the long run and contribute to a recovery.
Okay, now you mentioned the central bank's management policy of the naira, and obviously this has been a very topical issue for Nigeria. They've come under some fire from various analysts and a number of media outlets. What's your take on the way that the central bank has approached the naira in respect to the fall in oil prices?
We have to keep in mind that Nigeria doesn't have the luxury that some oil exporters in the Gulf, for instance, have, with very large wealth funds accumulated over the years, which they can use in order to keep up spending and sustain the economy. Nigeria has relatively modest reserves, no fiscal surplus to speak of, and therefore it opted to use currency devaluation as its lever to manage the situation. While it does that effectively and it protects its own fiscal position and credit worthiness, of course there are trade-offs, and those who find themselves on the wrong side of the trade-off will typically criticize the situation. And in this case, with depreciation of the naira, inflation that is high, interest rates that are kept fairly high to contain further inflationary pressure, households and consumption are particularly affected.
Okay, now you mentioned obviously the really important point earlier about the outlook for Nigeria's banking sector. To what extent have Nigerian banks been hit by the fall in oil prices in terms of their asset quality, and what kind of growth opportunities do you see for the sector as a whole moving forward?
Mm-hmm. Yeah, growth is obviously quite muted right now. The direct exposure of the banks to the oil industry is not a major concern right now, perhaps surprisingly to some. But we have to keep in mind, while the government depends heavily on the oil industry, up to 80–85% of its revenues, the bank's exposure is much smaller. It's probably 30% of their loan books. And the loan books of the Nigerian banks is relatively small in comparison to the size of their balance sheet, because they carry a very large amount of government securities as liquidity buffers, because they get a decent return on those. So the fact that the government's measures are geared towards protecting the government's own credit worthiness has some positives, because the banks are exposed to the government as well. With respect to their exposure to the oil industry, we have some visibility on who they're exposed to, and we get some comfort by the fact that they've lent mostly to the very large oil companies that have more financial flexibility than others, and in some instances a lower oil break-even price. We're more concerned about maybe a smaller portion that would represent maybe 3–4% of the loan book of the banks, where the loans are to smaller and weaker firms. But when we look at the type of buffers that the banks have, we think it's a manageable exposure.
Well, Jean-Francois, it should be a very interesting year for Nigeria, and thank you again for your time.
Thank you, James.